Everything you need to know about fair value gaps, inverted fair value gaps, CVs, BCs, gaps, imbalances, or whatever you want to call them. My name is Nuno. I've been funded with over 300k in futures prop firm capital, and in this video I'm going to show you when you should trust these fair value gaps and when you should avoid them altogether. A fair value gap is a simple 3-candle pattern like you're seeing right here. This is how it's going to look to your naked eye, but here's how I mark them. It's very simple. All you need to do is grab the top wick of the first bullish candle and the bottom wick of the third bullish candle. The space in between is going to be your fair value gap. Same thing for the bearish case scenario. You grab the bottom wick of the first bearish candle and the top wick of the third bearish candle. Now, this simply means that for the bullish case scenario, sellers tried to push price lower. They failed to close the candle all the way down here, making this gap right here. And this means that buyers took control on this area right here, and buyers have more strength than sellers. So an inverted fair value gap is going to be a little bit more tricky, so to say, but it starts as a bearish or bullish fair value gap. And this right here, you can see all the way until here, this was initially a bearish fair value gap, but then price traded one time into it, closed below, but still this candle closed bullish, right? And the next time we come and visit, we basically just ignore and we close above it. Now, I know that you're probably seeing another fair value gap right here, and if you're deep into the ICT stuff, I think some people call these BPRs. I remember reading about this somewhere, watching this somewhere at the time that I was learning, but I simply just combined them into inverted fair value gap. So you don't need this to be an inverted fair value gap. All you need to do is for price to come above, close here, and that's your inverted fair value gap. The next candle doesn't need to form the fair value gap. This candle could look like this. So this is the wick and this is like the body of your candle. This candle could have looked like this. This is still an inverted fair value gap because we closed above it right here. Same thing for the bearish case scenario, where you can see it starts as a bullish fair value gap, gets disrespected, and it flips into a bearish inverted fair value gap. And then we also, in this case scenario, we also create a bearish fair value gap. This to me, just like as a quick side note, this to me, like if we close down here, we visit, I put my limit order right here, we visit it and then we create another one. This to me is extra confluence for my trade. Now, there's something that a lot of people miss about fair value gaps, and it's high probability versus low probability fair value gaps. And this is going to have to do where these fair value gaps are going to get formed. So if a fair value gap is starting to form on trending conditions, like you can see, this is a clear uptrend right here. If they start to form right here, they're going to be higher probability, simply due to the fact that you're betting that a bullish fair value gap is going to hold on the bullish trend. So that's two confluences that you have in your favor. And you can see right here, price traded into this one. We traded again into it. We keep keep respecting the fair value gap until we quite don't. This is not the cleanest example, but if you're trying to apply this on your chart, it's not going to be clean. So this is why I picked up these examples right here. Then we visit up the second fair value gap, which you're still betting that it's going to hold, right? And you can see that it actually holds, price goes higher, and you can see that we created another fair value gap after that tap, and price just shoots up. And then you have one fair value gap right here, two fair value gaps right here, three fair value gaps, four fair value gaps, all in a row. Price stops right here, comes back, tests this one, still closes inside of it, and the next candle closes below. But same thing again, you're bullish, this is a bullish trend, so you expect that either this one, or this one is gonna hold. After this one held, you're gonna see the same thing again, like you're seeing here, and that is it formed another fair value gap once this candle impulsed up, and then price just ended up trending higher. Now, I could not fit everything into this screenshot right here, but if you want to look at this specific case, this was on the 2nd of January 2026, and the example below is also going to be from the 2nd January 2026. So another high probability fair value gap is going to be if they are formed on a high time frame PD array. So right here you can see this is a 4-hour order block on nasdaq. Again, 2nd of January 2026. You can look this up and you can see this playing out. You have the 4-hour or bullish order block right here. You can see we traded into it. I just picked this as an example because while I was doing the research for this video, it just happened that we were trading into that and it was perfect to take screenshots. And if you go into a lower time frame right here, you can see that there's a fair value gap getting created right here. And this fair value gap actually was created because we tapped the high time frame PD array right here. So this is the 4-hour order block. You can see that we dropped lower, right? And then we start to consolidate for a little bit. No fair value gaps are getting created. You can see like there's this wick, but then this candle just goes lower and no fair value gap is created. Same thing here until we create the first bullish fair value gap on the high time frame bullish PD array, right? And then price comes all the way down, taps the fair value gap and starts this uptrend right here. Now, this uptrend is actually the beginning of this uptrend that I showed you over here. So this all plays out nicely together if you know where and how to look. And you can see already this example right here is going to be fair value gaps that are formed in range bound conditions. You want to stay away from them, right? Range bound conditions are the enemy of fair value gaps and order blocks, because you can see right here that, well, there's this big fair value gap right here, but just for the sake of this example, you can see that we have this bearish fair value gap and then we trade into it. We inverted it. Now this is bullish and now this is bullish. From bearish, we went to bullish, and then here we went bullish again with this fair value gap. You can see price respects it, goes higher, sweeps this high right here, and then we go lower. But while we're still bullish, we're creating bearish fair value gaps. So already you can see like you got 1, 2, 3 fair value gaps contradicting each other and in the tight space right here. So this was a 1-minute chart. So 1, 2, 3, 4, 5, 6, 7 minutes, all created within 7 minutes. You have 2 bullish fair value gaps, 1 bearish fair value gaps, all inside the same range. So at this point, you want to be considering just staying out and not take any trade or not trust any fair value gap. And then same thing you can see right here. We close below this one down here, and then we trade higher into this one. We respect it, but you can see how this is messy. You can see how it went all the way up here, and then this closed as a doji candle. And then we start trading lower. We go lower, 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 and then we form the first bullish fair value gap after sweeping this low. This fair value gap does not get tapped. We formed another one, didn't get tapped yet. We formed another one. We tapped it, we respect it, and then we push higher. There's another fair value gap right here. So if you're paying attention to the first example, you'll be like, oh, we're going higher. But no, again, what happens again, because we were in the range, we just ended up sweeping this high. Price comes to visit the fair value gap, completely ignores it, okay, and inverts it, and then creates another big fair value gap right here if you're paying attention on this video. Now we tap that bearish fair value gap, we go lower again, and you can see where we just keep going from bullish fair value gap to bearish fair value gap to bullish fair value gap to creating a bearish fair value gap again, and then we create a bullish one. We invert it again right here, but while we're inverted, this is now bearish. Now we invert the bearish that was inverted from bullish, so this is a whole thing now, and then we created a bullish one, and then next time price comes in, we just start tanking. And this example is actually right here, so it's the same thing, it's the same screenshot, and you can see like if you just waited for better conditions, if you just waited for the high probability for value gaps, which is 1 formed at the high time frame PD array, you could have caught this trade right here with your stop loss down here, and you would have caught the beginning of the trend. Or two, you could have waited for a little bit more confirmation, wait for the trend to form, because remember, this right here is the beginning of this trend. You can check this out, 2nd of January, 2026. You could have waited for confirmation and just put your entry right here. And just as a side note, if you're placing stops based on fair value gap, you never place a stop on the first one. So if you take your entry right here, you never put your stop down here at the end of that fair value gap or the end of the candle of that fair value gap. You never do that, because this might happen where price is still bullish and we trade, it stops you out and then goes higher. So ideally you want to put your stop below market structure level, or maybe you want to count 1, 2, 3 fair value gaps and you just put down there, just so you give a little bit of room for your trade to breathe. All right, so this is fair value gaps. This is how I use fair value gaps within my trading, and this is one of the ways that I combined into a strategy that got me funded with over 300K in futures prop firm capital. Hope you enjoyed, and I see you in the next one.